Hi, everyone, and welcome to today's webinar, Angel Investing, Pandemic Disruption Creates New Opportunities. I'm Esmeralda Estrada from the Maricopa SPDC. I'll be the facilitator today. For this webinar, I'll be monitoring the chat throughout the whole webinar. So I'll get to know you all. But if you do have any questions, can you make sure to put it in the Q&A box? That way we don't miss any that get lost in the chat. So as everyone's joining us, would you like to go ahead and introduce yourselves in the chat so we get a feeling of who's here with us today? And here we have Lou Farina, who's going to be your presenter for today.
Good morning, everybody, and thanks for joining us today. So we're going to talk about angel investing today. We've got a lot of interesting material to cover. We do this webinar maybe every 3-4 months here at the SBDC, and our turnout seems to be good, and we get really positive feedback. So I hope you do enjoy it. As Esmeralda said, ask questions during the presentation. I'm happy to stop. It kind of gives me a little bit of a break to answer your questions, and hope get back to a more maybe fluid kind of presentation where we can kind of go back and forth. So don't feel free to put those questions in. Again, so here I am, Lou Farina, for those of you who I don't know. So my background in a nutshell, I did corporate, the Fortune 100 corporate investments venture work for about 25-30 years on a global scale. When I left, I started to get involved in the community. I was an angel investor here. I joined a group for about 3 or 4 years, and I've been doing different things. And the last two plus years, I've been with the SBDC, helping our early stage companies, variety of ways, but one of them in particular is how to raise early stage capital. So topics for today, what are we going to talk about? We're going to talk about startup capital in general. We're going to talk about angel investments versus venture capital. Okay, so that's a subtlety, but it's important for folks to understand, especially if you're thinking about raising money. Then we're going to profile an angel investor, a little bit of what he or she looks like, thinks, and then their ROI expectations as return on investment. And this is a little bit surprising for folks, and I think it may be, maybe kind of reveal some of the mystery around why the expectations are so high. Then we're going to talk about the impact of the pandemic, and things have changed here over the last 18 months or so, and they've kind of gotten to an interesting place. So we'll talk about that. We'll talk a little bit more about angel groups and the different platforms, so how to access them, who they are, and then we'll just finish up with some resources and some Q&A. So I'd like to start out with a slide about angel investors. And there's a lot of, it's a term, and it's a term that comes from some like film investing in the 1800s, and so it's kind of evolved, and what it means today is a little bit different than what it meant then. And often people think about an angel investor as truly an angel, an investor that's going to come down from heaven and provide money, provide guidance, and just make everything perfect with my startup. Well, that's not necessarily the case. Now, a lot of other folks are a little bit skeptical, and they're a little bit wary, and they see an angel investor and they think it's kind of that wolf in sheep's clothing, right? Be careful, and there's good reason to be careful, but that's not necessarily the case either. They serve a very important function, and they actually be very, very valuable. A lot of folks who I talk to say, yeah, I've heard of these angel investors, but it's kind of like a unicorn. I've never actually seen one. And so there's a little bit of a mystery. They don't necessarily hang a shingle out unless they're in a group. And so they could be a little tricky to find, but I assure you they exist. And then, some other folks think that, so money's just going to rain down from heaven. I'm just going to find my angel investor, and then it's just going to be all about funding me, backing me, helping me start my business. And that's not exactly true 100%. So Before we finish, well, before we start actually, let me just tell you a little bit about the SBDC. Give me about 5 minutes here and I'll give you kind of the infomercial. We are part of an America's SBDC network. So there's an SBDC in every state. There's 17 counselors in Maricopa County. There's 10 centers in Arizona. And Maricopa happens to be one of the centers. We do counseling, one-on-one, no-fee counseling. We provide training such as this webinar, and we have some resources, tools that we can talk about. We are funded in part by the SBA. At the federal level, at the state level, we're funded by Maricopa Community College District, and we actually are employees of the Maricopa Community College District. And when we are in an office, we are housed in their office facilities. So what do? We've got some specific technical assistance areas, and on top of the list here is disaster loan assistance. 18 months ago, that wasn't even on the list. But those of you who we've worked with, we may have worked with on a PPP loan or an EIDL loan or some other kind of government program. We're still doing a lot of that. We're doing a lot less of it as as those programs start to sunset. But more traditionally, we do a lot of lender readiness. So if you want an SBA loan or some other kind of loan, we typically know what lenders like and want, and can help prepare you. We can also provide referrals. We could provide financial review. We've got marketing tools, assessments. We have some expertise in buying, selling, and exiting businesses, manufacturing, technology, commercialization. That would be me. We have some specialists in export and international trade, as well as government contracting with a sister organization called PTAC. And they just specifically talk about or work with clients who are in business and pursuing government contracts. So a little bit about some of our resources for clients. These are some of the tools. These are no-fee tools, and they're good tools, actually. Growth Wheel is good for existing businesses. And helps. It's a decision support system to help prioritize and guide. We've got Live Plan. Again, these are free, but they would probably cost you on the outside. I think Live Plan is maybe $20 a month. What Live Plan is a business planning tool. So you can do you can start your business plan online, and it's got integrated financials. So it's all we're just talking about this. It's a lot better than me just sending you a template and say, hey, you need to write a business plan. So you can use this tool, and we can provide the seat for you. We've got Profit Sense, and that is a tool that allows us to use Sage Work industry data to do comparisons of your financials. So if you're an existing business and you kind of want to benchmark yourself against your competition, maybe in a geography or an industry, we can do that, run a ratio analysis, and help maybe even uncover some financial issues. Then we've got market research. We've got a custom service called SBDCnet. We've got IBIZ World, which are canned reports. These canned reports are actually really valuable. They're probably anywhere from $1,000 to $1,500 a piece on the street. We get them for you for nothing. And so if you're interested about your industry and where you're going, and you're starting in your business planning process, it's really good to look through these reports. And the other thing is, if you're going for a loan, or certainly early stage capital or an SBIR, you need some documented market research, and this can really help you with facts, figures that are sourced. So, Esmeralda, we are going to run a poll, and the poll is: has your company attempted to raise capital? Esmeralda is running the poll. And if you would just fill it in, it would help us understand a little bit about who we've got in the audience, and maybe how to tailor this presentation as we go through it. So you can see, I've not raised, but I'm exploring. We've pitched it, angels. We've submitted, we've secured, or we've and are working through the deal terms, or we've actually secured an angel investment. So in a second here, Esmeralda will show us the results. Okay, so good. We've got a lot of folks that are exploring the idea, and this will be good for you. The folks who have pitched and have submitted, excellent. We can certainly help you understand a little bit more about the process. And then we've got one that's actually secured angel investment, and it's terrific. So angels do exist. Okay, so let's talk about startup capital. And let's put it in broad terms and talk about some of the sequencing. And typically, to start up a business, you've got either debt capital or you got equity capital. Equity is when somebody invests and takes a percentage, an ownership position in your business. Debt is when you actually go to a bank for a loan that's most of the time secured, that you've got to pay back with interest. Now there's a third one also called non-dilutive capital, which are grants, contests, etc. And we'll talk about those also. So in startup capital, I will tell you that the first capital is the trickiest and most difficult, because no one wants to be first. And there's really a lot of constraints on you as you start. And there's really very stiff competition for limited sources of financing. So this is a tough space. You got to work really hard to raise money. And we all hear the stories about startups or entrepreneurs that walk in and they get $6 million with a 2 slide presentation, and that happens once in a while, but that's not the norm. And it's if you're a serial entrepreneur and you already have a successful exit or two, right? So you've built companies, you've created value, and you've provided exits, liquidation opportunities for investors to reap the benefits, and you've got a close network of viable investors. You probably had investors before. If you've done this a couple times, it's a lot easier. I mean, it's almost so you can walk into a VC and based on your reputation and a good story, you could raise some money. For 99.9% of us, this isn't the case. It's hard. There's lots of work, and I'm going to help you understand how to think about angel investors and how to work with them. And I just want to talk about debt real quick. So we do have a lot of startups that come to us looking for a startup loan. And one of the things about early stage companies, especially in the technology area, because angels typically like technology businesses, and I'll tell you why later, but they're risk seeking. Angel investors and professional investors they like risk, but they want the returns. Lenders are really risk averse, right? They're charging an interest rate, and they're going to secure it, and they just want to get paid back. And so it's difficult to get a bank loan for companies that don't have a financial track record. And I'm going to tell you, usually we use 2 years as a benchmark, but you can, less than 2 years if you're in business. There's potential. If you've got no financial track record, it gets even harder. So the decision factors for startup debt, do you have experience in this field? How much experience? Do you have a cash down payment? A lot of the lenders going to want cash down, 10, 20, 30%. Where's your product? How mature is it? If it's not really ready to sell, lenders are really averse to, lending money for development. What's your personal credit? You got to have really good personal credit, 650 plus, 700. Do you have collateral? They're going to, if you're at a startup and you're pre-rev or, just in rev, they're going to look to your personal guarantee, as well as collateral, 401k. Do you have real estate? Anything they can attach to. What's the quality of your business plan? How well thought out is it? What are your financial projections realistic? And industry sector appetite. So they're going to look for, like a bank is like any other investor to a certain extent. They've got a portfolio, and there are times when they're more interested in some sectors than other sectors, and so that's important too. So I will tell you, startup debt is a possibility. It is a long shot for many of the early stage companies, but talk to us. We can help you figure that out. But let's talk about equity investments right now. You ask somebody who's the first money into into a business, and typically it's yourself. And so what we've got here is we're going to talk a progression left to right. It's kind of a time series from an idea phase to what we call seed, pre-seed, seed, early, expansion, later. And these are arbitrary titles here. But and then the joke is you ask an angel investor, who's the second money into a business, and who is it? It's yourself. So the importance is that you've invested in the business, and you'll hear a term that's overused a little bit called skin in the game. But you have to have put money, not time, hard cash, into a business that's meaningful. Excuse me, and meaningful relative to yourself. So I've had a client who was working, put $50,000 into his startup, him and his partner, and they worked, they were working at Amazon in the early morning, late night shift, the 4 to 9, 4 to 10 shift, and then doing their startup stuff afterwards. So $50,000 for those guys is a lot of money. That's good skin in the game. So it's got to all be relative. Well, what's next? After you invest in yourself, who will invest in you typically? Typically, the next round is friends and family. These are people you know and love you. There's some public sources, AIC Innovation Challenge. There's potential for crowdfunding. There's accelerators, incubators, there's contests, there's grants, SBIRs. So these are all good early stage investment vehicles for you. And the point is, it's really before an angel investor will really step in. Typically, you've gone down this path. They never want to be the first money in. They never do, and they won't. And typically, so what are your other sources of funding prior to an angel investor? And after an angel investor, typically you can get into corporate venture, although it may be a little bit earlier, maybe without an angel. Corporate venture be like the Fortune 100, Fortune 500 companies all invest in investments, partner companies, technology, different type of vehicles. And then you've got venture capital, and then IPO, private equity, much later. So this is typically the sequence. It doesn't mean that if you've got to the point you're an angel, you got angel investment or even corporate venture or venture capital, that you can't get an SBIR. That's not true. Or you can't crowdfund. Maybe you can. They might not like it. Or you can't take, or maybe AIC challenge. I don't know. So, but what this really means is, like, typically before venture capital, you usually are going to have an angel group involved somehow or vesting together. So gives you an idea. Matter of fact, I'm going to talk to you later. I'm going to do an entire webinar starting next year on this kind of sequencing and specifically on these different areas. But today we're really going to talk about angel investors. So let's talk really about angel investors versus venture capitalists. And there's a difference, and it's important because a lot of folks think when they go to raise money, they're going to go right to VC, and that's not necessarily the case. So let's talk about, let me show you some data here. On the x-axis is the deal size. Deal size means the investment size. So am I investing $1,000? Am I investing $1 million or $100 million? The y-axis here is the total number of investors. So this is the volume of investors, different investors, individual investors. And what we're going to say is we're going to look at self. So how much money is usually put in relative to others for yourself? And so it's about $5 billion typical in a year that people self-finance. And the amount of money that's typically financed from yourself is from very little to maybe up 100,000, maybe more, but typically maybe 10, 20, 30, 50, 100,000. And there's lots of them, millions of investments. And then you come with your friends and family around. And so, yeah, there's less investment, number of investors. They provided a significant chunk of the money invested in early stage companies, and their deal sizes maybe a little bit longer, higher, 100,000 or more, but there's an aggregation of friends and family, so different people investing. Then you have grants. Grants, there's less grants, maybe 100,000 or so in grants, $3 billion invested. and their deal sizes could go up to, $500,000, $1 million if you're talking SBIR phase twos. And then there's some grants also that are, in the thousands of dollars too. And then angels, angels about $23 billion in any given year. And there's, the angel transactions, a little over 10,000 or so transactions. And then you've got, and then the range is between 100,000 and maybe $500,000 on the angel group, right? We'll talk more about that. And then you have venture capital. Venture capital is about the same dollars actually as the angel groups, which is interesting, but there's a lot less number of transactions, a lot less number of venture capitalists. We'll talk about that. And then other private equity. So, but venture capitalists, if you look, if I back up here, they're between 2 to 5 million to start up to, 20 to 50 million or so. That's typically their sweet spot with investment. And then here we got what we call kind of this disconnect, right? And if it's the $1 million to $2 million range. So if you're trying to raise $1 million to $2 million, you're kind of in a white space. You're kind of too small for the venture capital guys, and you're too big for the angels. So it's something to think about when you do your raise. There's things we can do here to kind of tranche it out, make it a little bit more digestible for angels. But that's typically a little bit of a flag when I see $1 million to $2 million on a particular raise, and we help with strategies around this. So angels fund 20 more times the number of companies than VCs. So most people didn't know that. So, we had some relative sizing on our last slide, but here in a typical year, angel groups may do $75,000 different investments or in companies, where VCs do maybe 3,750. I don't know what year this was from, but this is relative, order of magnitude or so more with angels. So there's lots of them out there, lots of activity. But VCs are easier to find, right? If you see the news and it's all about VC investments, that's what hits the news. You don't see angel investments. You can Google VCs, they'll come up, and they, pretty, their business. So there's a site and there's a shingle, and you can access them or actually find them. But angels, we'll talk about angels, and they're willing to invest across a lot of different industries. So this is what's important and interesting about angel groups. Here are the sectors that in this particular year that they were investing in. A lot of it's technology based, right? You got IT, you've got consumer products in the life sciences, a lot of IoT, mobile software, energy, healthcare, etc. And that's because angels, and I'm going to talk more about the groups, that their groups are comprised of a very diverse set of members. And so they can bring different expertise and help identify good investments and help provide resources to companies based on their expertise. So angels are pretty broad. And VCs have a higher degree of specialization. Individual firms, if you look at VC firms, they concentrate on 2 or 3 different sectors. And it's based on their internal expertise in the firm, because they're really become real specialists. And they've also got connections with other outside management expertise they may bring in after an investment, whether you like it or not. And so they tend to be fairly narrow in their approach. And so just a couple here, you got Kleiner Perkins, they like hardware, tech, enterprise software, healthcare. SL Partners, they like security, consumer, marketplace, etc. Bloomberg Capital like social media, private networks, consumer internet. Alloy Ventures likes life sciences, information technology, and clean tech. And is that all I've got? Yeah, that's all I've got. So and there's lots of different venture capitalists, but you'll see that they're very specific about kind of where they'll invest. Again, due to expertise. So now let's talk about an angel investor and profile them a little bit. Who are they? How do they think? So who and what are angels? They're typically high net worth individuals who provide this early stage startup capital for businesses. And they're typically accredited investors. And the SEC actually only allows certain individuals to invest in these less regulated investments. And they're typically Reg D of the Securities Act of 1933. You'll see a Reg D raise. That's what that means. It's an exemption, because the SEC is trying to protect the general public from these really risky investments that aren't registered, right? So they're specific about an accredited investor. An accredited investor either has there's a financial hurdle, $1 million in net worth, not including real estate primary residence, income over 200,000 for individuals, 300 for married couples, etc. But there was an amendment in 2020, which seemed like just not too far in the past, that actually broadened this, and they've had a whole new category and defines people who have certain professional certifications, credentials, experience. And so the really pool of angel investors were really broadened when the SEC put out this new amendment, and it's something you can look up on the internet. It's fairly easy to find. But the accredited investor, a matter of fact, I was emailing with a potential client here in the last day or so about becoming an angel investor, and talking about the accreditation. He said, well, how do I register? And I said, well, that's interesting. But when you join an angel group, typically you self-certify. And you look at, you review the criteria, and then you sign a document that says, yeah, I'm an accredited investor. So there's no real registration process from the SEC per se. And if you have questions about whether you might be an accredited investor or not, you can go to CPA. They'll help you out with that. So angels come in a couple different flavors, right? There's individuals, angels that run around and you can talk to and meet. And then there's groups, and there's angel groups that actually form these groups for investment purposes. Typically, a new angel will join a group, and that's what I did when I didn't know anything about angel investing, honestly, when I first started back in 2012 or 13. I came from, again, corporate ventures, and so we were dealing with private equity and maybe some VCs, but I never heard of angels. They were never on the cap table by the time they got to us. But these groups are formed really typically on a local basis. That's kind of the genesis. And they've got different expertise, and they've got different expectations as far as how much they will invest. There's usually some requirements, expectations from the group. And I'll talk to you a little bit about the dynamics there. And they hang a shingle. Hang a shingle means they got a website, and they've got a process, and you can access them and apply. Typically, somebody who may be involved in an angel group for a long time may maybe stay affiliated with the angel group, but maybe start to invest on their own because they've got a lot of experience and they're doing a lot of investments. And maybe I don't want or need the angel group the way I needed them when I started. And so you'll find individual investors too. They're harder to find. They don't hang a shingle. Usually they come by personal referrals, or they'll find you. Typically, you never know where they are. But a lot of what I always recommend for my clients is really to go, to try to network, but also go through the groups themselves, because it can be really beneficial, especially on a local level. The groups are, there's a nominal charge to join, and it covers the overhead expenses. They review probably 40 or 50, I don't know, in town here, about 40, 50 different investments a quarter, and maybe they'll invest in one or two. So, it's a tough filter, but they do fund people. I know a lot of folks say they've been through the angel groups before and they don't fund anybody. Well, that just means they maybe didn't fund you at the time, but they are funding, they are active. Let's think about this high net worth individual. And from a monetary perspective, right? The SEC gave some guidelines about the accreditation. All right, let's put that aside. Let's really think about if you're ready for an individual that's really ready for an angel investment or start angel investing. Typically, if you've got any kind of wealth or capital, you've got an allocation of assets in a portfolio. And this is, aside, angel investing aside, this is typically how you would, work with a financial advisor to help, construct your portfolio. And I'm going to say an angel investor, probably the typical profile's in his 50s. And, he's maybe let's talk about a $5 million portfolio. And there's a reason I'm going to use that. Is in the allocation typically would be 20% in bonds, stocks, foreign stocks, 35%, domestic stocks, 40%. And then there's maybe 5% in alternatives. And what are alternatives? So alternatives are these risky areas that round out your portfolio, and they're REITs, which is real estate trusts, metals, anybody investing in metals, or commodities, or private equity, which would be angel type of money. So typically only 5% of their portfolio would be in this kind of class of asset, right? And so it's a small amount. So, and I'm going to use this $250,000 number because the portfolio theory, as we're going to see later, says, you should really make 10 investments, and the typical angel investment is about $25,000 per particular angel. So that gives you a portfolio of 10 investments at $25,000, about $250,000. Well, $250,000, if you use the 5%, like, all right, I'm in my alternative asset class, I'm going to just have $250,000. That equates to about a $5 million portfolio. Okay, so really, if you've got, if you're investing $250,000 in angel really risky alternatives, you should, if you have less than $5 million or so, it gets to be, your portfolio gets to be out of balance, and it gets to be more risky for yourself. Doesn't mean people don't do it. Doesn't mean everybody has a $5 million portfolio, but this is the type of, this is the profile of typical angel investor. The folks have asked me about $25,000. What happens if you lose it? Well, odds are you're going to lose it, and that's part of the story here, and we'll talk about it more. But if you've got a $5 million portfolio and you lose $25,000 in an investment, it's not the right. Folks generally don't, can tolerate that kind of risk. And if you have $5 million portfolio and you're in stocks and bonds, and the market's going up and down, you're moving $100,000. It could be in a week or so, easy up and down. So it gives you an idea. So if you want to know more about the demographics about an angel, there's a report out there, the American Angel, and I think it was updated in 2019, I think, but it gives you all kinds of demographics, race, wealth, all kinds of age, experience, a whole report. So if those of you who are interested, I would point you to that particular report. The investment per round, per angel group per round, and this is important, that these groups will invest median about $202,000 a round. 48% are between $100,000 and $250,000. 14% from 0 to 100,000. 4% over 500,000. So we talked a little bit earlier about where the limit was, about 500,000 typically, and that's per round. That's per investment, and this is an aggregation of their membership, right? So nobody in particular is putting in $500,000 or $202,000. At $202,000 is likely made up of 10 investments of $20,000 each from the group. That's typically how it's done. So this gives you an idea of how much money you can or should think about raising from a particular angel group at any particular time. Okay. Let's shift a little bit and talk about the return on investment, because this is something that I think most folks who haven't done this before from an investment perspective really wouldn't understand or couldn't understand. And then when they hear it, they kind of don't know why, angels are so the bar is set so high for investment return, and why it seems to be unfair at certain from certain perspectives. So why are angels so selective? So I'm going to point to a study. There's this Wilbank study, and it's an old study, but it's a good. It demonstrates the what we're trying to get across. It's that angel investing is a very high risk asset class. Most startups lose money, and less than 10% of startups provide all of the upside for returns. So that's important, and I'm going to show you some math behind that. But if you look at the results of this study, you look at the 5-year return of investments of individual angel groups or individual angels. And so 35% of them got nothing back on their investment. 17% of them got their money back. So almost 50% got either nothing or their money back. And that's pretty good, actually. 34% of them got 1 to 5 times their money back. 5 to 10% of them, 8% of them got 5 to 10 times their money back. And then the home runs are here. The over 30 times their money, 4%, 10 to 32%. And this is what drives the overall return for the portfolio, not what's back here. So let me show you in some very simplistic terms what that means. If we take an angel portfolio and they've got 1 in 10 investments need to be that home run. And let's assume that these 10 equal investments of $25,000 each. $25,000 is a typical investment of an angel per round. So let's go back to this $250,000 number, right? I've got 10 investments of $250,000. 3.3x. So if I got 3.3 times my money on that $250,000, that would be a 27% rate of return over 5 years. So that's equivalent. Like if I'm in the stock market, the average rate of return over the last 10 years has been 13.9%. So if you just bought the market and held it for the last 9 years, you're getting 13.9, almost 14% on your money. Historically, it's more like 11. 27% for angels. Okay, so you look at this, and if you understand the amount of risk you're taking, you're saying 27%. Yeah, I'm taking on more risk, but that's not a lot of money returned to me for the risk that I'm taking. But let me demonstrate this in terms of what that portfolio would look like. So if I have 10 different investments, company 1 through 10 here, and I have $25,000 invested per company. If I multiply it through, and I assume that 50% of my portfolio is not going to give me anything back, I'm going to lose it, just a great big nothing. And then I've got a couple, 2 of them, I'm going to get my money back, the 1x. That's the 1x, $25,000 back. And then I've got 2 of them that are, fairly decent. They're going to give me 3 times my money back, right? So if I put 25 in, I'll get 75 out after 5 years or so. And then there's the home run, right? The home run is the 25x. So I'm taking $25,000 and I'm getting $625,000 back. But if I look at this as a total aggregation of my portfolio, I'm putting $250,000 in, I'm getting $825,000 back, and my total return is 3.3x. That 3.3x is equivalent to 27% rate of return over the 5 years. So this is key. This is really key to how angels think. And so everyone they screen, they're looking for the home run, because we know that even if you screen for the home run, this is probably what you're distribution of returns are going to look like. And so that's essentially why angels are always looking for highly scalable companies that can create value and be sold in 5 or 7 years or so for significantly more, 10x, 30x times their value, their invested value. So let me give you, let's go back and take an example of a 25x home run. What does that mean in terms of dollars? And let me just show you how that works. So I talk to a company and they say, okay, I'm worth $1.5 million today. We call that pre-money valuation. That's what the asset is worth before any future investment is taken. And the company wants to raise $500,000, I'm sorry, for 25% of the company. So I decide, yeah, I'll give you the 500,000, or the group decides we'll give you the 500,000. Our post-money valuation is $2 million, right? So $500,000 plus the asset, the pre-money valuation, the asset before I invested the $500,000 adds up to $2 million, right? It can't be less. It shouldn't be less. Hopefully it's more very quickly. And then $500,000 out of that 2 million, right? That's where you get your 25% ownership. So that's how ownership is typically calculated on the post-money valuation. And let's assume this fourth bullet here, there's no further investments or dilution of investors, because nobody else is coming in. So there's an exit event. Somebody buys the company and it's $50 million in 5 years. So it was worth 2. I invested my 500 at the time. It was worth $1.5 million. We got it to up to 2. 5 years. These guys have done great. This team has been terrific. We sold it for $50 million. So $50 million relative to the $2 million initial valuation, that's 25x return. For the individual, 25% of the $50 million is a $12.5 million return on he or she's $500,000 investment, and that's where you get your 25x return. So that's kind of the very simple math behind what a home run would look like. Key here is selling price exit for 25x. Okay. Any questions, Esmeralda, so far? Anybody?
No. Well, we do have some questions, but I think we could save them till the end.
Okay, perfect. Okay, thank you. All right, let's move on. And so what, pre-money valuation, and this is with 2019, there's some trending upward here, but when angels see entrepreneurs and founders and these ventures, when they invest, they've got to come to a valuation. This typically becomes a point of negotiation. And here's the distribution of valuations they saw in 2019. The median valuation was about $4 million. And these are for early stage companies, either slightly in revenue or pre-revenue, different within the different sectors that they're talking about, screen for a lot of different things. But there's only 7% that were $8 million or greater. 26% were $4.5 to $8 million, and up to $2.5 million, about 20%. So evaluation is a tricky area. A lot of people get caught up in the initial negotiation. Once you get to that point, I will tell you, no money is made on the valuation. I mean, when the transaction is made and based on the evaluation and you give an equity away, there's no money made per se, right? The money is all made on the back end when this thing becomes very profitable and attractive for a 25x sale. And so while it's an important negotiation, it shouldn't be the thing that holds back the investment from happening. Usually, most of the time they can agree on an evaluation. And I will tell you, valuations differ depending on, it's a lot like real estate in a way, depending on, supply and demand and where you are. If you go to Silicon Valley, right, typically your valuations are higher. Lots of money, chasing lots of good stuff. If you go to the Southeast, and there's angel groups there, but their valuations are lower for the local group, for the local companies. In Arizona here, we're kind of a mid-market. We're not California. We're not New York. We're kind of I would call us a second tier kind of market. We're a good, solid market, and our valuations probably would be represented by something like this. If you come in with a valuation that's way out of whack, most angel groups won't. If they like what they see, they'll talk to you and try to work with you on the valuation. But it's a lot of times folks get really centered on valuation and not necessarily what's going to drive the valuation, right? So, a lot of times, the conversation will gravitate towards valuation, where it really should be gravitating towards what is the value of this company. Really, is it a good investment? And then the valuation discussion can come kind of out of that. You really can't talk about valuation until you really understand or have opened the hood on the company and really looked under the hood and start to get into the nuts and bolts. So the other thing that's really important to angel investors is a clear path to an exit. And then the exit strategy isn't for money about the startup founders. It's not their exit. It's the company brings in money and the investors get money out. The exit is what gives the investors a return. Okay, so if you want an investment in your company and you have no plans to exit, you're going to have a very hard time getting angel investors. I'm not saying all investors, angel investors to invest. They are really looking for a liquidity event, which is usually another company buying your company at a seriously significant, at a multiple that gets you a seriously increased valuation and a return. And so that's got to be part of your story when you're talking to angel investors. What is your exit strategy? Part of that story is who are the likely acquirers and why. I'll tell you about like medical devices, right? It's very common for medical devices to be developed and acquired. Depending on the kind of device, you can tell and know who might acquire you. Also in your sector, you can do some research and see where the acquisitions were. Having an idea who acquired who for what in what sector and how that kind of fits with your story is really important. This information about companies exists, and you have to go do a little digging to find it, but it's there. Okay, let's talk about the impact of the pandemic. So what happened with angel investing during the pandemic? And I'm not going to take you through the 18 months quarter by quarter. Let's talk about just kind of in general where we've been, where we are. The angel ecosystem has remained strong. Early stage investors are resilient. They are risk tolerant. Most angel groups did not view the pandemic as a threat per se. They learned how to adapt and move forward. Initially, there were some initial valuation decreases, but that's all kind of stabilized now. And it's just because maybe there was some less investments going into new companies. Some of the investments were going into existing companies to help them with the cash crunch. Viewed in the context of this 5 or 7 year time horizon that an angel group has or an angel has, the quarterly ups and downs don't matter all that much, right? We're looking to build companies for the long term, typically with a 5-year exit horizon. Definitely, there were sectors that were impacted weaker and stronger. There were some sectors that really benefited by the pandemic: life sciences, digital health, some of the mobile, process automation, security, delivery services, hardware, ed tech, blockchain. The weaker sectors that kind of suffered, and these are sectors that suffered in the general economy, but also in the entrepreneur space, the hospital, type of services, automotive, civilian aerospace, high-end fashion, right? Hotels and hospitality, anything associated, any innovation associated with hotels and hospitality, sports and recreation, arts and entertainment. So we saw some stronger, we saw some weaker. Things are starting to stabilize, and they're starting to normalize a little bit. So what we all learned, and we continue to kind of experience during this pandemic, and is that work need not be limited by physical space, right? So there's a spatial diversity, right? We figured out as an economy, some organizations more than others, how to function without being physically located with each other, right? There's all kinds of technology we're able to use, and there's quality of life benefits for the employees or of the companies, of the organizations, and there was further realization, to extend this concept, and the angel groups kind of said, well, hey, let's, startups, if people don't need to work in the same space, why do startups need to be co-located? And so there was more of a tolerance for startups that were in different geographies and not necessarily all located in one geography. And what that meant also was an increased access to talent, right? So now if I'm a startup and I say, I don't have to have everybody in the Phoenix area, I can go find my talent elsewhere. So now the talent pool increases, and theoretically the quality of the startup itself could increase. So what we also learned and saw is, capital flows were flowing now cross-state, cross-region with regard to angels. Angel groups, the genesis of angel groups are typically organized by a geographic region or state or city. And a lot of that is because the angels are physically located near each other. They know of each other through a local ecosystem. And they can vet companies that are located, that are close to them. So that's kind of how it started. But now what you're seeing is this early stage capital, because of the spatial diversity, because of people being located all over the place, they're now less constrained by geographic proximity. And I'm not saying this is 100% of their deal flow, but they're more willing to look at companies that are not in their geography. Maybe in Arizona, maybe it's the Mountain West. Maybe in Texas, maybe they're starting to look more into the California. So new opportunities have been created, and this creates not only for angel investors but for companies. Now, maybe you could get an audience with somebody, an angel group that's not in your locale. So increased engagement opportunities, right? So this is a double-edged sword here. So virtual pitching is here to stay, right? We're gonna, people are going. It's just so convenient to light up a Zoom call and have somebody get on the other end and give their pitch, right? You don't need to bring them into a conference room, and you don't need to get everybody together. It's really convenient, and I think it's here to stay. So increases the volume and scale you need to in order to get your business funded, right? But the downside here is like Zoom fatigue. So yeah, it's great, but we all get tired of Zoom, right? And so there's shorter attention spans, and pitching is actually become, you need to be crisper. I have a little graphic here: be brief, be bright, be gone, right? So you could easily lose your audience in the first 30 seconds. How many of us have gotten on Zoom meetings and just within the first minute go, oh gosh, and you just kind of tune out, right? We've all been there. Maybe some of us are still there, but my point here is, if you get an opportunity to start to pitch by Zoom outside of your locale, make sure your pitch is second nature. Make sure you've practiced. Make sure it's polished, crisp, on point. Absolutely critical. You may get your 10 minutes or 15 minutes, but if you lose folks in the first 30 seconds or minute, it's not productive for yourself, even though it might be a little easier to get the meeting. So that's kind of my soapbox on increased, virtual pitching. Additional thoughts with regard to the pandemic. So VCs, what they did, and we didn't talk about them really, is they kind of shifted up a little bit. They went to later stages. So they wanted companies that are a little bit more mature, a little less risky. And so that gap that I showed you, that $1 to $2 million gap between VCs and angels kind of widened a little bit. And what you saw is angel syndication become more critical. So what angel syndication is angel groups will actually work with each other to fill out a round. So I'm here in Phoenix and I can, there's a $500,000 round for this company that I really like, but with my constituency, I can only raise $200,000. I might reach out to another angel group that I know and have done business with before, maybe the folks in Utah, maybe some folks in Colorado, and say, hey, I've got a good investment for you. We can do two. You think you guys could fill out the other 300? Would you look at it? And so there's more of that going on. So they can syndicate to maybe get to the bigger raise. Angels continue to play a critical role, not only in funding, but the expertise to help guide their companies during troubling times. And this is really evident during the pandemic when, especially their portfolio companies. Portfolio company is a company that you've invested in, right? So you've got an existing investment. And so angels were able to, with their, expertise and experience, help guide these companies during the pandemic. What to do, how to do it. There's no formula, there's nothing, but it was really nice to have experienced folks that they could, these entrepreneurs could go to help navigate. Many portfolio companies, reduced headcount and cash is king. That was important, especially during the pandemic. So you'll hear a thing called burn rate. What's your burn rate? So preservation of cash became critical. I think with a lot of different companies, with a lot of different sectors, the economy in general for any of the small business, but very important also for companies, what they call their portfolio companies. So let's talk now, we're getting towards the end here, about angel groups and platforms. So the groups, as I mentioned, typically are local, right? There's groups here in Arizona, but there are also platforms, or there's groups here in Arizona, I'm sorry, and there's groups in each individual state. You'll find different groups, multiple groups per state, but there's also platforms that span the United States and aren't tied to a particular geographic area. So in an angel group, how are decisions made? And this is really important to know. This is kind of behind the curtain. So there's no group consensus mechanism, right? It's not a digital decision in a group. It's not yes or no. There's typically no fund, and I'll talk about a sidecar fund, double asterisk here, but there's typically no fund that it's not like an investment fund, right? The funding is the sum of the aggregation of the individual commitment. So this is typical. And I got a little picture here that shows like how many people want to invest in this company after you go through a lot of the due diligence and some of the upfront screening and pitching. And if I got, here at 1, 2, I got 3 hands, maybe 4 hands up. So, okay, we're going to, that group makes the decision. They want to invest. They get off together, form a group, go talk to that company a little bit more and decide how much they're going to each individually invest. And that becomes the fund, the funding mechanism, okay? So it's important that when you're pitching to angel groups, you're pitching to the group, but you're not pitching necessarily for a group consensus. You just got to convince, if there's 100 in the group or 80 in the group or 50, get that 5 to 10. And then you've got, typically, the way it works in a group is you've got your leaders, people that are specialists in certain sectors, and then are followers. And say, look, if that person's going to invest, then I'm going to invest also because I know that person knows this particular area pretty well. And so that's kind of how it works. Sidecar funds do exist, and that what you can do in an angel group, you can put money in a fund. I just said there are no funds, but there are this sidecar fund. And what happens is that sidecar fund will match as a percentage of a commitment from the constituency. So if the constituency says, all right, we're gonna put $200,000 in, we've got 10 investors, the sidecar fund could then match, maybe put 50,000 or 100,000. It's another way for an investor to invest in the angel as an angel, part of the angel group. So a lot of people put money in a sidecar fund and then do the individual investments. So let's talk about groups, right? Geographic proximity. There's your local group. Let's say we're Arizona here. Then there's typically like the Mountain West. So you might work with somebody in the local group, and you might reach into somebody in the Mountain West because of geographic proximity. It might reach to somebody, a group in Utah, a group in Colorado, New Mexico, California, actually, California. And then there's national. Okay, so you can reach out to New York, other places, and those groups are typically geographically, again, seated. They're kind of in a certain area and like to work with companies that are in that locale, but now are accepting, meetings and pitches from others. And so there's this ability to work out towards from your locale. But then there's virtual platforms that you'll see that are on specific verticals. So they're not necessarily a group per se, a traditional angel group. They may focus in a certain area, and it may be platform driven, just a platform. And they're investors from all across the United States because they may have expertise in energy or fashion or something along those lines. So you'll see those groups too, and we'll talk more about them. So let's talk about the local groups. Who are the groups here in Arizona? Okay. There's 1, 2, 3, 4, 5, 6 I've got mentioned here. 6 predominant groups. ATI here in Phoenix, tech investors. There's Canyon Angels. They're also here in Phoenix. But they look at investments from all over the state and even outside the state. There's Desert Angels. They're located in Tucson, and the Desert Angels are a very active group. They do a lot of the medical type and healthcare investing because of the proximity to the med school down in Tucson and some of the other specialties they've got down there. Golden Seeds is a group formed exclusively for women, so for women-based ventures. And there's a couple other groups, Arizona Disruptors and Arizona Founders Fund. One of them, I'm not sure which. I think the Founders Fund is run by Hamid Shoeji and his wife. They were the principals in Axosoft, and they got a huge exit, and they're putting some money back into the community. So these groups, you can go on their sites, and you can they will tell you how to engage with them. Typically you're going to need a business plan, a pitch, financial projections, fill out their application. Here at SBDC, myself and there's some others, we can help you with this process as you go through this process. We kind of know what they're looking for, so feel free to use us in that fashion. But now let's look at the Mountain West. And I just took, one from each area. So there's groups. There's Park City Angels in Utah. There's Sierra Angels in Nevada. Nevada, typically not a real active angel geography. Tech Coast Angels. Anybody? Most folks know the big Southern California group. Rockies Venture Club out of Denver. New Mexico Angels out of Albuquerque, and there's others in these particular states. So these are just some of the ones that are in the Mountain West that you could particularly approach. And then national, right? You know, you look at in New York, there's New York Angels, there's Band of Angels, Chicago Archangels. There's a fund in Charlotte called the Charlotte Angel Fund, which is in like the Research Triangle. There's the Alliance of Angels, not sure where they are, and North Texas Angel Network. So there's a bunch that are kind of spread throughout the United States. They may say, hey, we'd like to focus on New York based companies, but you know, they we know that they'll talk to folks that are outside of their locale, especially based on what's gone on here with the pandemic. And then the platforms. So, you know, there's Angel MD, right? These are for healthcare technologies. These are all doctors who are looking to invest. And so there's a platform. And how to get on these platforms, everybody's a little bit different. Some could be fairly difficult, but they're available. There's chemical angels. They typically focus on chemical type of startups. Life science angels. There's fashion angel. E8. I think they're out of Seattle. They do a lot of alternative energy investments. Although they'll say, hey, we prefer Seattle, but I've had clients talk to E8. If you've got some kind of energy based startup, you're fine. So yeah, there's more out there. You'll see them. Here's some resources, and again, you'll get a copy of this, and you don't have to take a screenshot. But there's the Angel Capital Association. There's it's a trade organization essentially. There's a lot of information they release. They've written a report on the pandemic specifically. So again, if you're a report person, it's all free. There's the Angel Resource Institute. They've got a bunch of information. The American Angel Study that I referenced. It's an older study, but it's got a lot of demographics. There's the Angels Funders Report from the Angel Capital Association. It talks about funding. There's the Halo Report from the Angel Resource Institute, and that talks about funding. And these are updated either quarterly or yearly, and kind of keep track of all the metrics and whatnot. So have at it. Okay, so I guess this is a good point to pause for questions, Esmeralda.
Yeah, sorry. So we have a few. So can you talk more about accelerator investors?
Accelerator investors, is that what you said?
Yes. Yes.
So accelerators will, you know, they work in a couple different ways. They can provide you services in kind and or cash, and they may ask for a small percentage of your company as equity. Incubators typically won't, but accelerators can. I've seen that. It's not, you know, not every accelerator. Sometimes you pay to go through the accelerator, or sometimes they choose you. And so that whole, you know, funding, support, equity is kind of specific to the particular accelerator. And if you had specific questions about somebody you're talking to, let us know. We can help you out.
All right. So we do have a few more questions. So is ownership decided at the initial meeting with the investor? Do they always need to be a part of ownership, or just initial startup cost and payback?
Well, so any angel investor is going to want ownership, equity. Most of them do not want to control your company. They're looking at about 20%, maybe a board seat. They want to be involved, but they don't have the time or bandwidth to really run your company. So, but you're going to get some help for the investment. And that's a priced round. That's what we call a price round. That means, okay, I set a valuation, I got an investment, it comes out to 20%. That's what our equity is. A lot of early stage companies will do what they call convertible notes or safes. And that is a mechanism that allows you to defer the valuation conversation to the next event. So it says, okay, I'm going to put money in. Let's say in a convertible note, it becomes a loan until it converts to equity when there's an equity event at the next So it's just, you're too early to come to a valuation, and the investor accepts that and accepts some of that risk and write some terms in the note to help compensate him or her, and then you punt it. So yeah, and again, I know that was a little more than this what we covered in here, the mechanisms, but we can certainly help you if you're talking to investors about the different mechanisms.
All right. So another question is, are angels typically interested in national startup companies? What is a possibility or percentage of angels investing in a local company?
So say one more time.
Are angels typically interested in national startup companies? What is a possibility or percentage of angels investing in a local company?
I would say that still, even with the ability to reach across states, regions, to other groups, I would say 80%, 80 to 90% of the investments here in Arizona are probably done on the local level with local groups, local startups.
And then a question more specific is, do you feel it's worth the time to try for an angel investor? If I am looking to expand my massage practice, I am trying to put together a medical massage team and be a little different than the typical massage industry.
I would say that's a tough one. Not tough one that I don't want to answer it, but I don't think it would fit into a typical angel investor profile, because of, it's not that, it's a service business. They don't really like services because services don't scale. The hardest thing to replicate is a person, right? So anything that's people dependent is not really scalable. So yeah, unfortunately, I don't think so.
And then we had a question about the reports that you mentioned at the beginning. So it's, can you explain the reports again that are free through SBDC? This was discussed on one of the first few slides.
Yes. Okay, great. IBIS World. So you can go into, just Google IBIS World, IBIS World altogether. And there's a portal that's a public portal. You can go in and you can search the reports for the ones that you think you might need. Then you need to become a SBDC client. And so if you contact us, we'll show you how, I'll show you, matter of fact, on the next slide, I'll show you how to do that. And then you get you come to me and you say, hey, we talk about your business. I need these reports. I download them and I send them to you. But you need to be an SBDC client. Again, it's a no fee service. We just need you to register because we are accountable to our grantors, especially, the SBA, and we need to show that you're a client before we provide services and content.
Thank you. So another question, what's a good way to get introduced to local AZ angel groups? Do they hold annual pitching events or networking events collectively?
No, they do not. So what you need to do is go to their site, whoever that local, and I'm going to pick ATI, Arizona Tech Investors, let's say, go to their site, and they'll have a button, apply, and then they'll walk you through their application process and what they're expecting you to submit. After you submit your information, then it's screened by a group of the angels, called a screening committee, goes through a couple screens to see if they want to invite you to pitch. Okay, so you put it in and then you kind of wait. And if they say, okay, we want you to talk to us, then there's an opportunity for you to talk to them. So, and then there's a couple pre-screens and then they get you down, and they only take about 2 to 4 pitches per quarter, or say, maybe every 4 months or so, or 3 months. And then you get, if you make it that far, then you get to pitch in front of the constituency, which is all of the investors all together in a room. And that's how you will get a decision made by those individual investors.
Thank you, Lou. Those are the questions that we had so far.
Okay. All right. So let's go here. So again, the SBDC counseling experience, you want to talk to me more, we've got another counselor who's got experience here. What happened to this? Oh, you set up an appointment, go just request counseling and say, I've talked to Lou, or I want to talk to Lou. It'll go into our system and you'll get some emails, and then I'll be contacting you. So, usually what we do, we look at it, funding is important, especially early on, but our initial counseling sessions, we'll talk about your business, your goals, try to get to understand really where you are. And then, we typically have follow-on sessions and to track goals in meeting with your counselor on a regular basis. There's no obligation to continue to meet. I mean, we think once most clients engage with us, they'll want to continue to meet because we can be valuable advisors, not only again through the fundraising process, but through the life of your business. So here's some upcoming webinars. Tuesday, October 26th, we've got a couple, a Grow with Google series, reaching more customers online. And then another one, Tuesday, November 16th, how to sell online with e-commerce tools. And then on Wednesday, November 17th, we've got a seminar on international logistics. Then we're going to start the new year, and I don't have a schedule for the new year, but I can tell you on the tech side, which is the kind of webinars that I help manage or do, we're going to go back and have our series for intellectual property, patent basics, and trademark basics. This is all done by the USPTO for the SBDC. I'll be doing this SBIR overview again, at least a couple times next year. We're going to bring someone in to talk about software development for non-technical entrepreneurs. I'm sorry, the SBIR one, I did that last week. So yeah, we're going to continue to do the SBIR one. And then we're going to do the angel one. And then there's going to be a new one that talk more broadly about the alternatives and that chart that we saw in the beginning about all the different alternatives. And we're going to take a little bit of a deeper dive into those. So again, Maricopa SBDC, you can follow us on Facebook, on LinkedIn. You can go to our webpage. We have resources, COVID-19, a lot of the pandemic related programs. We've got our training events calendar, our counselor biographies. If you see somebody you know or like and want to meet with them, when you request counseling, just put their name in, you'll get routed. So thank you for joining us today. There'll be an evaluation. Esmeralda?
Yes, before I do a little closing, we do have a few minutes left. There's 2 questions that came in. Would you mind answering them, Lou?
Yeah, go ahead. Yeah.
Yeah, okay. So the first one was, do you have an available list of accredited verified investors we may access to seek out investment or funding from, please?
That's something that we don't have or keep. And the reason is, they're not public entities, they're individuals. And so they're not really advertising. The best way to access those accredited investors is to go through the groups, because they form their groups. That's where they are. That's where they congregate.
All right, thank you. And then how do angels monitor the company performance once they've invested? Meaning, do they have financial reporting required of the companies?
There's no reporting requirements per se, but I will tell you, if you take on investors, you will want to report on a regular basis. And I always encourage my clients to do investor newsletters on either a quarterly basis or a monthly basis. And what that's going to do is going to help you, because what you don't want is your investors calling you up asking for meetings all the time, and you kind of got to, you got to, work with them. So the newsletter is a way to keep people abreast, and the most efficient way to provide your updates to your investors.
All right, thank you so much, Lou. So those are it for the questions. Thank you everyone for joining us today, and thank you, Lou, for today's presentation. Once this webinar ends, you'll have an evaluation. That evaluation will help you with future webinars that we provide for you to help your business grow. And I'll be sending the recording along with the PDF of this presentation today within 24 hours. So you could expect that email from me. Thank you once again, everyone, for joining us. Have a nice day.
Thank you, everybody. Have a good day.